Today shows that although banking profits are slowly recovering from levels seen during the 2008 liquidity crisis, with both retail banks and investment banks growing interest and non-interest revenue, overall confidence levels remain weak. So why are the two out of sync? Emilio Pera, lead banking and capital markets director at Ernst Young, joins us now so we can unpack it all. Thanks so much, Emilio, for joining us this afternoon.
Good afternoon.
Well, looking at that headline number, I mean, the survey found that banking confidence has fallen from 45 index points in the first quarter of this year to 33. That's quite a big pullback that's come through. Have you been surprised at the weak confidence levels that persist?
I suppose, especially on the investment banking side, the immensity of the drop from above 60 basis points all the way down to the mid-20s was a surprise. Although investment banks do tend to be more volatile when looking at confidence. And then you have to consider it's also in the global context of the Greece crisis in the last quarter, and also the European, or the concern around liquidity and transaction volumes based on the concerns raised in Europe.
Well, certainly it's that investment banking arm that seems to be placing a lot of pressure on this overall index. Let's compare it to the retail segment and how things are faring in that regard, because they seem to be on divergent trends.
Absolutely. On the retail banking side, definitely a steady improvement, not sharp improvement from the previous quarter, but both interest and non-interest income have improved slightly. There's been a sharp drop in your bad debts, which is also a very positive sign. However, also a significant increase in costs, and especially IT and resource expenditure, which I suppose could be an indication that over the past 2 years there has been quite a focus on containing costs, and especially with new regulations coming in, and maybe in preparation of the World Cup and the marketing spending improving.
Well, certainly, I mean, what's interesting is that they do have the confidence to actually start building up their spend when it comes to marketing and system costs as well. So to what extent are we looking at this as a positive signal? Because we know that all through 2009, banks were actually slowing down quite drastically their overall expenses.
Yeah, exactly as you're saying, it's showing that there's confidence in the market, and for the rest of 2010, we hope to see more confidence or high confidence levels coming up as the economic figures also improve. And the fact that after, as you mentioned, the last 18 months, especially the high bad debt numbers, the fact that they've dropped down significantly is a clear indication that we've turned the corner, and we ready for improved.
That on the retail banking side. I mean, if we take a look on the investment banking side, while yes, we have these the global forces exerting themselves in a very big way, corporate demand for credit in particular remains weak, and the recent corporate sector credit extension statistics actually corroborate with that. I mean, what's your outlook in terms of activity levels and investment banking income growth moving forward?
Yes, if you look at corporate finance stockbroking activity, there definitely has been a pickup in those two segments. However, treasury and other corporate investment banking activities has remained very slow, and especially in the volatile markets, it is quite a surprise that treasury activity has been as slow as it has been. However, if you look at the last 2 or 3 quarters, the investment banking index is very dependent on global markets, and as I mentioned earlier, unless we get another shock, we hope to see that improving, and also activity levels improving.
So we're basically going to have to sit on our hands and wait for a turnaround in the global economic picture, the global confidence picture, before we see any turnaround here?
On the investment banking side, on retail banking, definitely improvement, but I think on the investment banking side, there is definitely a dependence on global markets. What we have to consider is also the positive press that South Africa has received over the last couple of weeks with the World Cup, as to whether that's going to have an impact over the next 6 to 12 months.
Overall, though, Emilio, looking forward, I mean, what is your outlook in terms of the kind of confidence levels that we're going to start seeing filtered through? Because while the retail segment may be a little bit more confident than the investment banking arm, collectively we're seeing pretty drastic downticks here.
pretty drastic downturn, although also if you look at the fact that the banks are spending money for the future, definitely early indications that they have a positive view as to what's to come. I think if you look at the second quarter, there were specific elements in the global markets that we had to contend with, and unless there's similar shocks over the next couple of months, we anticipate that there would be improvement.
Well, on that note, let's leave it there. Thanks so much, Emilio, for having joined us this afternoon.